It's that time of the week again to take a look at the potential market-moving events and data releases that could influence the financial markets next week. Joining me to discuss the week ahead is Schulz, Senior Economist at Berenberg Bank in London. Christian, before I go on to discuss next week, this week the People's Bank of China surprised the markets with a 25 basis point cut to its benchmark interest rate, the first cut since late 2008. Now, this move comes just shortly after the Chinese government dashed market hopes of a considerable size stimulus package. But as downside risks to the growth continue to pose a challenge to the Chinese economy, do you think they may decide to respond with a stimulus package to cushion the economy?
Well, a stimulus package in the fiscal sense, where they invest more into infrastructure, into other growth initiatives, is certainly still on the cards if the Chinese growth levels decrease further. But the monetary side seems to be the road of choice for the Chinese at the moment. The Chinese economy has cooled down, but this was wanted by the government since inflation rates edged to above 5% last year. They've come down considerably, as has growth, so now is the time for stimulus. But as last year, when they lessened the monetary stimulus, it will first go back to monetary stimulus before they embark on fiscal stimulus, which the last time they did it after the Lehman crisis was very effective, but not necessary just yet.
The SNB meet next week to decide on interest rates. Now, their foreign exchange reserves surged to 304 billion Swiss francs in May, which does reaffirm the SNB's determination and ability to hold the 120 euro Swiss franc floor. Analysts' opinions are divided over whether the floor could be broken in coming weeks. Do you think this will be the case or not? And also, Christian, are you not concerned about the consequences of holding the floor and continuing to intervene at such a pace? One of which is the growth of the SNB's balance sheets.
Indeed, the purchases of the Swiss Central Bank have reached a worrying level. For the first few months of the target that they set since September, it seemed that the signal effect of the central bank's determination was enough to actually stabilize the Swiss franc rate, and the central bank didn't need to actually buy very much at all. In fact, they could even sell some. But with the re-intensification of the crisis, and possibly also after the Swiss Central Bank got into political trouble when its president stepped down last year, it seems that the markets are not as convinced anymore that the Swiss Central Bank will stick with its target. So at the moment it looks as though the markets will test the resolve of the Swiss Central Bank again and again. This will lead to higher purchases of foreign assets by the Swiss Central Bank, and will indeed increase the political pressure on the SNB to stop it. So this becomes a vicious circle, if you like. However, there is also some hope for the Swiss Central Bank. If by the end of this month the European Union or the Eurozone gets its crisis back under control, then the pressure on the Swiss Central Bank to purchase more assets will decrease. So in a sense, in a lot of ways, the decisions are out of the hands of the Swiss Central Bank. It just has to hope that the European Union and the Eurozone get their crisis under control.
Recent US economic data have been disappointing, although the Federal Reserve's chairman Ben Bernanke has shied away from hinting at injecting more stimulus into the economy. Do you think the Fed will eventually engage in more quantitative easing?
The labour market data, which came in very weak last week, was, of course, a slowdown, but it also confirms a trend that we've seen over recent years where, because of the deseasonalization mechanism that the Fed uses, the winter data always seems to be look too positive, whereas the spring data looks too negative. So it's questionable, and we see this in the beige book of the Fed, which was published this week, whether there's really much of a slowdown or whether this is just a statistical effect, because the purchasing manager indices for the US, so the sentiment indicators, are still all quite positive. They're all above the 50 level, indicating expansion. The ISM manufacturing, the ISM non-manufacturing are both above the 50 level. So the US economy still seems to be growing. There's not an imminent need for further stimulus, and as with the ECB, it's also questionable what the marginal benefit of that would really be, with interest rates being so low already in the US. So we're not expecting Operation Twist or quantitative easing anytime soon, certainly not ahead of the elections, unless things really turn ugly again because of the euro crisis.
Christian, we've highlighted a few potential talking points for next week, but as investors continue to search for financial safety, what else should market participants keep a close eye on next week?
In terms of economic data, is relatively thin. There's a lot of inflation data, but that's not going to worry markets too much at this point. What markets will be focused on is the political developments in Europe. We have on Monday, of course, the publication of the IMF assessment of the Spanish banking sector. So we'll get a figure on how much public money will be needed to recapitalize Spanish banks. And that will then trigger the discussions of whether the Spanish government will accept a bailout or not. So that's going to be a crucial date. Furthermore, we have a meeting in Germany between the government and the opposition on the fiscal treaty and how to approve it and what the conditions of the opposition for this will be. This will really determine how much flexibility and how much ability for compromise the German government will have at the end of the month meeting, which of the Eurozone and European leaders, which could be quite crucial. So this will be also something to watch. And then, of course, we'll be in the run-up to the elections in both Greece and the parliamentary elections in France. So the polls for these countries and the mood of these countries will be watched very closely. These polls could both be very important and decisive for the next few weeks and how much turmoil we'll see in the markets.
Christian, thank you very much for discussing some potential market movers for next week. Now we'll have more interesting interviews coming up on... Christian, thank you very much for discussing with me some of the potential market moving events next week. Now coming up on Dukascopy TV, we'll have more exclusive interviews and the last edition of Targets in Focus, as well as a press review. But for the moment, goodbye.